Well, hello everyone, and welcome to the start of our venture or our journey in accounting. This course is dealing with managerial accounting and cost concepts. Now, what is managerial accounting? And we'll find out here the difference between managerial and financial accounting. Financial accounting is concerned with reporting financial information to external parties such as stockholders, creditors, and regulators. Financial accounting deals with strict rules. These rules are determined by the Financial Accounting Standards Board. These are concerned with public companies, so companies that sell stock on the New York Stock Exchange, American Stock Exchange, or NASDAQ. And they must follow rules on reporting, and they must follow generally accepted accounting principles. What is revenue, what is a cost, what is an asset, etc. And so they are determined really to provide consistent and comparable financial information to outside people, to people that own stock, people that have lent the company money, etc. Managerial accounting is really for internal managers, and it is asking questions and providing answers to those questions. So it isn't as structured as financial accounting. It may deal with, okay, how much does it cost for me to make a hamburger? How much does it cost for me to make a computer or a car? How much does it cost for me to send a plumber out to make a service call? And what if I changed a parameter and changed the way I'm doing business? How is that going to impact my profitability? So the data is less structured, and it really is, what do I need to know? And so what information do I need to determine to be able to answer these questions? And so we're going to be dealing with those types of information. So for classification, we have to assign cost to a cost object, and we'll talk about that in a minute. We're accounting for costs in manufacturing companies. Now, you have this large manufacturing company or a large building, okay? And the building is used for all sorts of different products, maybe. If you're a car company, it may be a couple of different cars. And so you start at this end, and the car moves through, and along the way, you have people that are adding parts to that car, and you have people that are working on adding the actual parts. And so as the car moves through this manufacturing process, you accumulate the cost of this, okay? And so you have these people working on the line, and they're paid a certain amount of money, they have a certain amount of benefits, so they have an hourly rate. And if it takes them 2 hours, then it's two times their hourly rate. And so you add that to that car at that point. If you're adding a part like an engine, maybe that's $1,000 or $2,000. You've added that engine, so now you've got the cost of the engine, the cost of the labor to put that engine in there, and it moves to the next stage. And then maybe this you're adding doors, okay? So now you're going to add the cost of those doors, and you're going to add the cost of the labor to do those doors. But then you may have someone that supervises some of these people, all right? And you may have parts that are really worth tracking to that particular car, glue or a bunch of screws or uh, the solder they're using for welding. It's not worth the cost of figuring out how much of that is going to that car. It would be like saying, well, how much ketchup Or how much mayonnaise do I add to this hamburger? Okay. Well, it's not worth it. You would just say, well, that's overhead. And so you still have to assign those costs somehow. And that's really what we're going to be looking at for the first four chapters is how do we assign those costs, those overhead costs? Um, you prepare financial statements. Again, for financial accounting, it's a strict process of this is what is revenue, etc. And then you use this to predict cost behavior and responses to changes in activity. And we'll talk about that. And again, the bottom line here is that this is what accounting is our product is information. And we're providing that information so that people can make informed decisions to increase profitability, save on cost, increase revenue, etc. So learning objective one, understand cost classifications used for assigning cost to cost objects. And we're going to be really looking at direct cost and indirect cost. Direct cost that can be easily and conveniently traced to a unit, product, or other cost object, direct material and direct labor. So for instance, if that hamburger, what goes into that hamburger? Well, we know buns, we know meat, cheese, bacon, etc. So those are direct costs. Those are direct material costs. That hamburger consists of those. And then we know it takes someone to put all of that together, someone to cook the meat, someone to put it onto the bun, someone to spread the mayonnaise, etc. And so those are direct costs. They're directly manufacturing this hamburger or they're directly manufacturing this car. Indirect costs are costs that cannot be easily and conveniently traced to a unit of product or other cost object. At that fast food restaurant, the manager, he isn't directly involved in making the food. He or she are overseeing all of the different components, the drive-through window, making sure everything clean, the security, the um, front desk. So it's not reasonable to trace that person's cost to each individual hamburger. So what we do really is those are called overhead, indirect costs, and we still have to again account for those. So we have to figure out some way to assign those costs to that hamburger, to those french fries, so that we can then figure out, are we making money? So common costs, indirect costs incurred to support a number of cost objects. In a manufacturing facility, managers, you would have the people that bring in the parts and then move those parts from the warehouse to the production floor. They are overhead. You would have the whole building. There are certain spaces that are, again, warehouse space. That would be indirect cost. That would be overhead. Or you have space used for specifically creating those costs. So in your mind, and this is going to be part of homework, you have to determine, is this a cost that's involved in the manufacturing process? And if it's not, then it's going to be called what we call period costs. So classification of manufacturing costs, again, we have direct materials. For that car, it would be every component, every part we used. And normally it's called a bill of sale or bill of sale. That's not the term I'm looking for. Anyway, you have a list of all of the parts that go into that vehicle. Every tire, every screw, every seat, engine, steering wheel, lights, fuses, etc. So you have this big direct materials, and those go into making that car. For the hamburger, you have, of course, the bun, the meat, the lettuce, the tomato, the cheese, etc. Those are direct materials. And then you have people, and their job is primarily responsible for making that product, okay? And so they put that sandwich together or they put that component into that car as it moves to the next stage. And then, of course, again, the manufacturing overhead, that would be the warehouse space, the um, machinery used to move this stuff around, the electricity for all of the manufacturing facility, the security guard. If you have an accounting person that is only focused on the manufacturing facility, that would be overhead. If you have a HR person that is only focused on helping the manufacturing employees, that would be overhead. Again, you're going to collect all these costs and you're going to figure out some way to attach them to a product. Again, direct materials are raw materials that become an integral part of the product, a seat installed in an aircraft. Direct labor are the cost for the labor. So that person, it's their cost plus their benefit cost. And so we multiply that times the number of hours. Manufacturing overhead, again, includes indirect materials, indirect labor. So ketchup, we're not going to measure each dollop of ketchup. We're going to go, well, how many bottles of ketchup did I use? How many hamburgers did I make? And we'll assign the cost that way. And so somehow, again, you have to assign cost. And the most um, common way really is probably by labor hours. So what you'll do is you'll say, how much is my manufacturing overhead going to be? You budget it. And how much are my direct labor hours going to be? And it's a simple mathematical equation. Estimated overhead divided by estimated labor hours. And if that's $5, for every direct labor hour that we produce, we're going to add $5. So if this person uses 2 hours of labor, we're going to add another $10 to that product. Depreciation of manufacturing equipment, utility costs, property taxes, insurance premiums incurred to operate a manufacturing facility. These are all overhead costs. You can't say, well, that property tax, that much of it was for that particular product. It's not worth the expense of determining that. So we, again, accumulate them and then we're going to divide and figure out some way to pass them along. Now, when you combine direct labor and direct material, that's called the prime cost. But the direct labor and the manufacturing overhead are called the conversion cost. So direct labor is both prime cost and conversion costs. Now, outside of the manufacturing environment, you have selling costs and you have administrative costs. And these are called period costs. So, in other words, whenever you incur these costs, you expense them. So, selling costs are not part of the manufacturing process. If you watch ads, you'll see that there's a lot of advertising that goes into products. Okay, that's why television exists. That's why radio exists. That's why the internet exists now because of all of the different advertising. That's a selling cost. All right. So when you incur those costs, you're expensing those. That's not part of the manufacturing environment. If you're in real estate and you have a real estate agent and they get a commission on selling, that's a selling cost. And so that is expense. Administrative costs are accountants, managers, HR people, anything related to the non manufacturing side. So there's going to be a difference. If I said the insurance for the manufacturing facility, is that a period cost that's expense when incurred, or is that part of the product cost? Is that part of the manufacturing? Well, since it is insurance for the manufacturing facility, then that would be part of the manufacturing process. Now, if I said insurance on the corporate headquarters, Well, they don't manufacture anything at corporate, so that's going to be overhead or administrative costs, and so that's going to be expensed. So again, product costs are part of the manufacturing. You don't expense these costs until you sell the product. So you accumulate these costs, you assign the direct labor and the direct material to the product. You have the overhead, and then you're going to allocate this overhead to this product along with the direct material and direct labor. And then you're going to come up with the cost of that hamburger. And then you're going to expense those costs when you sell the product. And that could be a car as well. So they attach to that unit. Raw materials. You have three different inventories. So basically, at the end of the month, you have to figure out, all right, where are my costs? Raw materials would be that engine. So I've got an engine in stock and I'm going to put it into my car. So work in process would be at the end of the month, you have various cars in various states of readiness. And so we've attached all of these materials and all of these labor costs and this overhead to each one of these components. And so anything that's not complete, we know, and we're going to add all those up, and that's called work in process. Finished goods is exactly that. It's goods that are ready to be sold. And so they have all the components ready, and so they're now in finished goods inventory and ready to be sold. So when direct materials are used in production, their costs are transferred from raw materials to work in process. And then once it's complete, then that goes to finished goods. And so here is product costs include direct materials, direct labor, and manufacturing overhead. And once and then the inventory, again, you have three types: raw materials, work in process, finished goods, and that would be on the balance sheet. Once the product is sold, then it goes to the income statement. You reduce your inventory, you identify the cost of the product you sold, you record the revenue, etc. So again, product costs are not expensed until you actually sell the product, whereas period costs are expensed when incurred. So the insurance on the corporate office is expensed each month, whereas the insurance on the manufacturing facility, that's going to be assigned to a product, and that eventually is expensed once you sell the product. So which of the following costs would be considered a period rather than a product cost in a manufacturing company? And you want to look to things that what is not part of the manufacturing environment. So I've mentioned it, property taxes on corporate headquarters, not part of the manufacturing process. Sales commissions, that's selling, not part of manufacturing. So of course, B and E would be the correct answers. Now we're also going to break down cost into different, like variable cost, fixed cost, and mixed cost. A variable cost is a cost that in direct proportion to changes in the level of activity. All right, so you have these components of the hamburger, and the more hamburgers you make, the more buns you use, the more meat you use, the more lettuce you use, etc. If you don't sell any, then you're not going to use any of those. Now, of course, in this type of environment, you probably have waste, but let's don't consider that. But each time you make a hamburger, these costs will go up, but the cost per unit will stay the same. So a variable cost per unit per hamburger is going to be constant, but the total is going to increase. An activity-based cost driver will say, okay, how are we going to allocate this overhead? Are we going to do it by units produced? by machine hours, by labor hours, or by units sold. And we're going to get into this much in much more detail in the next three chapters. Fixed cost is a cost that remains constant in total regardless of changes in the level of the activity. That would be the fast food restaurant. You've got a fast food restaurant. Whether you do one customer or serve 100, you basically have that restaurant. And you have to pay for the depreciation of the building and all the equipment, etc. And so that's a fixed cost. Now, fixed costs are a set amount, but as the volume increases, the cost per unit goes down. Variable cost, it's the same. That hamburger is the same. But the more hamburgers I make, the more I can spread those fixed costs over those hamburgers. Committed means it's not easy to change. You can't just suddenly get out of that building. All right. Discretionary may be altered in the short term. All right. So here's sort of a linear assumption of the relevant range. So what is a relevant range? Well, basically, if you look at Chick-fil-A, their restaurant could do so many. I mean, if they are operating at 100% of capacity with one drive-in window, they could only do X amount. So they added a second drive-through, and this increased their capacity. So now their relevant range has increased because now they can do more volume. And that's what a company is going to do at the beginning of the year. They're going to go, how much volume do we expect to do? And so this is the relevant range. And that depends. If you're a restaurant, you can only, if you're maxing out, that's it until you add additional space. If you're a small restaurant, you're going to be in this range. So again, variable, the total goes up, but the per unit stays the same. Fixed, the total is the same, but the per unit decreases as you do more volume. So you want to hit that sweet spot, which is usually around 80%, I think. So which of the following costs would be variable with respect to the number of ice cream cones? All right. Would the cost of lighting the store change? No. Would the wages of the store manager change? No. The cost of the ice cream? Yeah. The cost of napkins? Yes. All right. So these two would increase as volume increases. So these are variable costs. These are fixed costs. And then you have mixed costs, which might be something like if you have a cell phone plan where you have to pay a certain amount fee, and then if you exceed so many minutes, you increase those costs. And then here is mixed cost, etc. Okay. Um, Decisions involve choosing between alternatives. The goal of making decisions is to identify these costs that are either relevant or irrelevant. All right. Differential costs are the difference in cost between any two alternatives. So a difference in revenue between two alternatives is called differential revenue. Both are always relevant to decisions. So I'm making, well, do I want this product or do I want this product? So this product means maybe I use more labor, but this one means maybe it's more, but I use less labor. And those, you're looking for the difference between those. Opportunity cost is what is my best use? All right. If I choose this option, what is the difference between what my return would be with this option versus this option? And then sunk cost means, all right, I paid for a concert. Nothing I can do about it. I can maybe try to sell it, but that's already sunk cost. I've already paid for that. It's already, you know, an out-of-pocket payment. So if for some reason I can't go, those are sunk costs. All right. Now that's not the Okay, well, let's look at this. So suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash. You don't want to waste money. Is the cost of a train ticket relevant to this decision? In other words, should the cost of the train ticket affect the decision on whether you drive or take the train? Well, yes. Okay, because you have a difference. You can either drive, which is you're going to have to pay for gas, but the train ticket, of course, is going to be a certain fee. So that's part of it. Now, suppose you're trying to go to attend a concert, you have ample cash, but you don't want to waste money needlessly. Is the annual cost of licensing your car relevant to this decision? No, because whether you go or not, it won't affect the licensing cost. You're going to have to pay for that anyway. Suppose that your car could now be sold for 5,000. Is that a sunk cost? No, because now you can get money for that. So when your ticket, if you could sell the ticket, then that would affect whether it's a sunk cost or not. And then the merchandising, the traditional format is going to be sales minus cost of goods sold equals gross margin. We're going to be looking at the contribution format. All right. So in other words, the contribution margin is the sales price less those variable expenses. So if we're selling that hamburger for $10 and it costs us $3.50 for the meat and the bun, etc., then our contribution margin is $6.50, and that is going to contribute to paying for our other expenses, for our fixed expenses. So this is going to be much more familiar. We're going to, when we do cost volume profit analysis, we are really going to be looking at this format, and we're going to be looking at the variable sales and variable cost per unit, dividing that into our fixed cost to determine what our break even is. So the contribution income statement is used as an internal planning. Again, cost volume, profit analysis, segmented reporting, budgeting, and then special decisions. And that's it for chapter one. It's just sort of a introduction. Again, you should know the different types of cost, fixed versus variable, direct labor, direct materials, overhead, and you should really get in your mind what these actually are, because the next three chapters we're going to really be going into determining these amounts and doing some calculations.